Hello, Nebraska, and welcome to this week's edition of the Retirement Compass, the show that helps you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio are two members from Stonebridge Wealth Systems based right here in Nebraska. We have Tim Kulhanek, he is the co-founder and a financial advisor, and Jeremy Gove, partner and financial advisor. The title of today's show is Investing Fear During an Election Year. The reality is that 2024 is an election year, and with that can come a lot of fear and uncertainty and potential policy and administration changes in Washington. What could all of that potentially mean for you and your retirement? That's what we're going to be talking about today. Tim, Jeremy, excited to be with you as always, and
likewise.
we've got a big show to get to. So what do you say we just dive right in?
Sounds good.
All right. Well, the reality is every time we have a presidential election in our country, it seems that with it comes a lot of fear, a lot of uncertainty, a lot of questions about what the stock market may or may not do and how one should potentially invest their money. And so if you're feeling any of that fear, we want you to first know that you are not alone. I have some statistics here to share with you. This is according to a recent survey by the Nationwide Retirement Institute. Almost half of investors believe that the 2024 election will have a bigger impact on their portfolios than market performance. That says a lot. 32% of investors believe the economy will plunge into a recession within 12 months if the political party they least align with gains power. Republicans, Democrats, and independents believe that the outcome of a presidential election will have a direct and immediate and lasting impact on the performance of the stock market, and 80% of investors are worried about a possible recession. So wow, that's a lot to take in. But my first question for you guys today is, are you seeing these fears and concerns come up when folks are coming in to meet with you for the very first time?
Without a doubt, I'd say that the election is probably the number one concern that folks are intimating when they come in for a meeting. And it makes sense. This is a demographic we're meeting with on a regular basis. We primarily work with still some silent generation folks, but a lot of baby boomers and Gen Xers. And they're the ones that seem to have the most vested in the political landscape. And I looked up a study as well. It was the 2021 Generational Power Index. It's from a company called Visual Capitalist. It's a great online website where you can helps you illustrate and understand things in a more visual way for those who are more visual learners. And those three groups account for around 70% of all voters, but 95% of political spending. So it makes sense that these folks, they're very vested in what's going on. They're very concerned about what's going on. What makes all voters, though, kind of the string that ties it all together, is they often make the mistake of mixing their politics with their investing, and that is a recipe for disaster. The refrain I hear quite a lot is, this time it's different. And that goes back to Sir John Templeton. Back in 1933, called that the four most dangerous words in investing. And we always feel like this time it's different. And on the political side, I think the stats that you referenced just tell me that the kind of the propaganda for both parties is effective, because we hear it all the time. Since I have been alive, for sure since I've been able to vote, the first election I voted in was when I was in high school, and it was Bush, Gore, Bush, Kerry, I can't remember which one came first or the other. But this is the most important election of our lifetime, right? And this is the most important. And so it's that same kind of refrain we hear all the time.
Yep.
And the reality is, when pundits are making these claims, these kind of dramatic types of claims, we need to keep in mind that whether it's about taxes or interest rate changes, we need to keep in mind they're not financial advisors. They're not licensed to give advice. Yep. It's more of the fear tactic to try to get people to sway, one way or the other. And they usually think that it's going to be different this time. But the reality is, there's a reason why, the way I put it is this: history doesn't always repeat itself, but it often rhymes. And so we have to understand that, things are going to be different in how they unfold, but ultimately, here we are 200 plus years into the Republic, and it hasn't collapsed yet, thankfully. So.
Well, but you make a really important point, and that is that often when we turn on the news or you're listening to these political pundits, they're making political points. They're not giving you financial advice, but it's very easy when you're hearing these things, especially if you don't have the education, the financial knowledge in place, which so many folks don't have that, and that's not their fault. Our system hasn't taught people a lot about retirement retirement planning and how to manage your money and all of that. So it could be easy to conclude, oh, based on whether this happens or that happens or this or that or the other, I might need to change my investment strategy altogether. But is that necessarily the best thing to do?
Yeah, I mean, again, a lot of times people think they need to, and it's driven by fear. And there's a reason why, we always say, don't let your emotions impact your investment decision making. And I think it's probably attributable to Warren Buffett saying that there's two things that drive the market: fear and greed, and be greedy when others are fearful, and fearful when others are greedy. And again, the studies show that Republicans and Democrats both tend to be more optimistic when their guy or gal or whoever, their party is in charge, but both tend to be wrong in that estimate as well.
This is so interesting. I know you all have brought a lot of research to today's show to share with our viewers. So Jeremy, can you shed some more light on that?
Yeah, so one of the studies that we found, it's called Political Climate, Optimism and Investment Decisions by the Social Science Research Network. And what they found is basically what Tim said, that when Democrats are in power, they tend to be more optimistic. And when Republicans are in power, they tend to be more optimistic. And so, but by, I guess, vice versa, if you're a Republican and the Democrats in office, then we're going to be more pessimistic and we're going to invest more conservatively. And so just taking that, to the level of investing, if you're pessimistic, you're going to be more conservative. If you're optimistic, you're going to probably have more money in stocks. And as a result of that study, one of the interesting things that they found is when Democrats are in power, they actually earn 2.7% more than Republicans do.
So when a Democrat's in power, the Democrats who are investing earn more.
Yeah.
Right. Okay.
And it's not a conspiracy theory. It's just the fact that they keep more of their money invested in stocks.
Because they're optimistic.
Because they're optimistic, providing that return.
Right.
And vice versa. When Republican investors are in office, or when a Republican's in office, they tend to be more aggressive and leave their money in stocks. And so they end up earning that 2.7% as well.
So in other words, if your person's in power, you're more optimistic, therefore you put more money into the stock market, which means you end up earning more. So it has nothing to do with your political affiliation. It's just how you're feeling and what you're doing with your money. Right,
absolutely. I mean, you ask yourself this question, if the person, how certain are you that the person you want to win is going to win? And if you're pretty certain about that, you're probably going to stay invested. You're probably going to continue to be optimistic going into it. If you're not sure, we have a lot of people asking us, should we just go to cash right now and wait till the election's over? Or I've got, X amount of money in CDs that I would like to put in the market, but I think I'd like to wait till after the election's over. And so, depending on their situation, that may or may not be the right advice. But as Tim mentioned early in the show, we don't want to make decisions based off fear.
Exactly right. Yep. Well, and I'm glad you're bringing this up because I have heard that as well. And I heard this, I've been in this industry now. This is my third presidential election that I'm seeing. And I hear the same things of, should I go to cash? Should I do this? Should I do that? People want to make these big moves or these, almost, I don't know what the right term that's coming to me now, but polarizing, right? With their strategy, doing these big things based on what may or may not happen. So one of the things that's interesting is this whole behavior confirmation bias. So talk a little bit about that, how that comes into play.
Well, yeah, behavioral finance is actually becoming a bigger and bigger thing because we're starting to understand the psychology behind investing and the psychology of how we deal with risk and all that stuff. But basically, it's the behavioral finance confirmation bias. And so what that allows, or what basically we end up doing is when the party that we align ourselves with is in power, we're more optimistic, and vice versa, we're more pessimistic when the other one's in power.
Yep, and that has everything to do with your stock allocation, nothing to do with your political affiliation.
Exactly,
right?
Yeah.
For sure. Well, what is the best way to combat this? Because obviously we want folks to be prepared no matter what happens in Washington. We want you to make sure that you can be certain despite all the uncertainty that's out there. So what are you doing actively for your clients to help them navigate the complexities of this being an election year with their investment strategies?
Yeah, the reality is it's no different than any other year because we're always on to like the next thing, right? So oh, well, then it's election year. Well, now there's a new administration, so now I have to be worried about this next thing. And so a big part of what Jeremy and our team of lead advisors do here at Stonebridge is behavioral finance, is making sure people develop a plan and stick to the plan. It's a lot easier to stick to something if you know it's part of a broader strategy than if you kind of fly by the seat of your pants.
Right.
And like, to me, the folks watching probably have three different options. They can just keep going the way they're going and hope everything works out. Option two would be, to dig in, do the research. One of the things I hear all the time is, election year, I heard it's bad to invest in election year, which is completely incorrect. Actually, election years have a higher average return than all years combined. So all years combined going for the last 100 years might average, let's say 10.3% for the S&P 500, and election years are actually a little bit better than that. There's another kind of seasonal type of strategy people will use. They call it sell in May and go away. And, okay, well, you don't want to invest in these interim months because most of the bear market damage is done in those months. Well, turns out in election years, that's not true. So we want to stick to a plan. But in order to stick to the plan, we have to have a strategy in place. That's what we do at Stonebridge with a complimentary written financial plan, is you're going to have all 5 key areas of your plan analyzed. What a written financial plan is basically it's just a document that outlines all the areas of where your income is going to come from, which account to draw from first, the taxation of that, how much we need to allocate for things like healthcare costs in the future, minimizing your taxes. All 5 areas: income, investment, tax, healthcare, legacy. But at the end of the day, what it means is when you leave our office, you're going to know that your plan has been tested from A to Z, thousands of different ways. It's been stress tested in good markets and bad, rising interest rates, falling interest rates, rising taxes, steady taxes, falling taxes. All the different ways that the next 30 years of your life could potentially unfold, we're going to test those, and you'll have confidence and clarity in knowing that your plan is designed to work long term. It's going to help you stay committed for the long term through the hazards and vicissitudes that come with life, a lot better than option one, which is just kind of hoping things work out.
Right. We don't want just to rely on a strategy of hope. So
hope's not a strategy.
No, for sure not. Well, and as one of my mentors said, money is not red or blue, it's green, right? And that's the name of the game. We want you to have a solid plan in place, as Tim and Jeremy have stated, so that you can weather whatever storms may or may not be happening in Washington. So of course we have a lot more to get into today, but to claim your complimentary written financial plan, you don't have to wait. We encourage you to pick up the phone, call that number you see on the bottom of your screen, 866-256-7778. Or you're also welcome to take out your smartphone. And if you open up that camera app, you can point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary visit that way as well. Don't go anywhere. When we come back, we're going to be sharing some more data with you to make sure that you can prevent political uncertainty from derailing your investment portfolio. Stay with us.
My story started when I was in college. I was trying to figure out what I wanted to do. I knew it was going to be in the financial industry. I took a lot of accounting and finance classes. I thought I'd probably work in like a bigger company and work my way through maybe the accounting department. But then when I was doing a internship the summer before my senior year, I walked into a business. I was trying to sell magazine ads. I don't know if I call it magazine ads, but basically ad space in the back of the UNK student handbook and planner, which was a difficult sell because, nobody uses pen and paper planners anymore, at least not college students. But I made my best pitch to some financial advisors. I happened to be Scott Noctegal that I met with that day. When I went for the close and tried to see if he was ready to sign up for some ad space, he said, yeah, no, I'm not interested in that, but it takes a lot of courage to have somebody to be willing to walk into a business, especially a business that really doesn't cater to your target audience, to put yourself out there in a way that the odds of you being successful are probably pretty low. That's the type of person we'd be looking for at our firm. Have you decided what you want to do? And I said, no, I really haven't, but I only want to work with finance because I like numbers, and math's always been my favorite subject, and working with kind of complex equations, almost like a puzzle. And so that's really where it all began.
Welcome back, Nebraska. You're watching The Retirement Compass, brought to you by the team of Stonebridge Wealth Systems, based right here in Nebraska. I'm your host, Kristen Oakley, here with both Tim Kulhanek and Jeremy Gove. And today we've been talking all about investing fear during an election year. We know there's a lot of uncertainty, a lot of concerns. To your point, you were sharing a lot of folks coming in for the first time saying, gosh, should I move all my money to cash, or should I make these huge swings with my investment strategy as a result of it being an election year? But as we are pointing out, it's never good to make fear-based decisions and emotional decisions with your money, because it could have negative effects for you. So let's look at some more data that shows the importance of staying the course and remaining invested with your investments. The following comes from a study that was put together by Invesco. It was called People Care About Elections, Markets Don't. So one of the findings of this important research was that the markets have actually performed well under both parties. Talk more about that.
Yeah, it's a great point, Kristen. So as you said at the very beginning of the segment, we don't want to make decisions out of fear, right? Mm-hmm. And so we need to have some data points so that we can make educated decisions. Right. And so that's kind of the purpose of this segment. Mm-hmm. So if we want to pull up a chart, if you look at this chart, it shows the full range of one-year returns for each president going back to 1961. Mm. And what you find is, with a few exceptions, the returns look pretty similar.
Yeah, they do.
You know, mm-hmm. Whether it's red or blue, they're pretty similar. And so as a maximum one-year return, as an example, is 44.1%. The maximum one-year loss is 19.4%. But they're red and blue, you know, their gains and losses going both directions. So it doesn't really matter if it's a Republican or a Democrat.
Right.
If we look at the next chart, this is also an interesting one, where you're looking at annualized market returns for each president dating back to 1957 through January of 2024. And again, it's, and I guess it's tying to the corresponding economic growth in terms of real GDP. Mm-hmm. So that's what we're seeing on the chart. And again, the performance looks pretty familiar, pretty similar. So it doesn't really matter which party is in power. The S&P during that same time frame, the S&P 500 index actually rose by 11% over that 75-year period. Mm-hmm. And so, and the U.S. economy also expanded by 3% during that time frame. So mm-hmm. the bottom line is it didn't really matter. There wasn't a big swing one way or the other. And so, right. Again, we try to make decisions based off facts and not, what we are fearful of or what mm-hmm. we're scared of, so.
Yeah.
So I think that does a good job of showing that.
Oh, for sure. I mean, basically, the reality is that neither party can lay claim to superior economic performance, no matter who's in power, right? That's kind of what that sums up.
Yes,
sure.
That's exactly right.
Well, one of the other observations from this study was that the markets don't care if you don't like who's the president. So let's look at this next slide here. And Tim, can you walk us through what we're taking a look at?
Absolutely. So this is going to show the growth of $1,000. And what you can see is, starting from, I think we're at 1953 or 1954 on this one, if you only invested during Republican administrations, that $1,000 would grow to $31,000.
Yeah, that little red line there at the bottom, right?
Yeah. You can barely see it.
Yeah.
On the other hand, so if you're more of a Democrat persuasion, you might be thinking, I knew it. When my guy's in, it grows to, wait for it, $50,000. Now that is better than $31,000.
So yeah, that's if you were only invested when there was a Democrat in power.
Yeah. And specifically we're talking about in the White House. So this isn't talking about the balance of power in Congress, it's just in the White House.
Yep.
Now, what if you would have just stayed invested the whole time, regardless of whether it was Republican, Democrat, red or blue? I'm just going to stay invested. And this is we're looking at stocks in general. There's the S&P 500 and an Ibbotson index that we use for the more historical type data. So what we find is almost 1.6 million. So like the bottom line is pretty clear, folks, mm-hmm. from the chart. We don't really need to give any more explanation than what you're seeing on your screen. Sticking to a plan is critical, and you're going to come out with a lot more money than if you're picking and choosing when to invest based on the political affiliation of the president.
Yeah, I mean, think of how much money you would have lost, right? If you had only been invested when the president of your political affiliation was in power. But yet, seeing these facts, you've even said it, you're hearing people even now say, well, maybe I should pull all my money out of the stock market and move to cash. And so this is something that a lot of folks are really concerned about. So again, why is it so important to not let one's emotions get involved and to remain invested. I mean, clearly that chart shows it, right?
Yeah, absolutely. I mean, well, what you saw was a huge cost, a huge opportunity cost.
Sure.
For sure.
And so, I mean, if you think about, well, okay, so let's say you're a Democrat, you had, what was it, 51,000 versus over $1 million?
Right.
Sure.
Yeah.
And so, I mean, you could be, there's so many things you could do with that money versus, you know, so there's a huge opportunity cost that is lost there. And if we have one more chart or one more slide that we can pull up, and it shows that if you had invested the $10,000 in the S&P 500 in January of 2003 through December of 2022, yeah, on this chart, you can see what would have happened. Basically, if you're trying to time the market. So
jumping in and jumping out.
Jumping in and jumping out. Yep. And so if you look at the far right, that's saying that we just missed 60 of the best days of the market over that time frame. So over that roughly 18, 19 years, we missed 60 days, the 60 best days of the market, we would have $4,205. And so if you go to the middle where we missed 30 days, that's $11,701. And so it's crazy. If you just miss the 10 best days, you'll have $29,708. So timing the market is very costly. If you just stay invested, you'd have $64,000.
Right, if you had remained invested the entire time.
Yeah, so you'd have double the money if you stayed in almost all the time, but just missed the 10 best days. And so that's a pretty crazy statistic that a lot of people don't realize, but having a chart like that is helpful. And that's something that we talk to our clients about. You know, let's look at what do the facts tell us. Before we make this knee-jerk reaction and, you know, get defensive, let's look at the facts.
Right.
What does that mean?
Well, because the reality is no one can predict when the best days in the market are going to happen. And often the best days in the stock market are happening right on the heels of the worst days. But if you've jumped out, by the time you get back in, you have missed that growth. And that's why it's a problem.
Yeah, and that's why it comes down really to philosophy at the end of the day is what approach are you taking? We know we don't want to be moving in and out. And like Jeremy and I and our team, we've seen over, you know, the last 15 years or so, a lot of different strategies come and go. You know, there's some money managers that will come and they'll say, look, we've got this figured out. We've created a better mousetrap. And, you know, we've got this system. You know, like, I can talk about a system where, you know, using our secret formula, we're going to be able to miss the worst 10 days of the market because actually avoiding the bad days is a lot more valuable than missing the best days. The best days, right. Yeah. So if you look at the offset between the two. But at the end of the day, it works until it doesn't. You know, so there's a lot of strategies that I don't name them by names that showed great historical performance, but then all of a sudden when the rubber meets the road and it comes to the next thing, remember how I said earlier where it often rhymes, but it doesn't repeat itself when it comes to history. What happens is we have market down. Just think of the pandemic. You know, it was a 30+% drop, but did it take place over a year or, you know, 600 days? No, it took place over about a 2.5, 3 week period where we saw the market, we saw the S&P 500 drop 35% roughly from peak to trough. But then it was a V-shaped recovery. There's not a lot of strategies that would have been designed to handle that. So what I mean by philosophy is, you know, we use what I refer to as a core satellite approach, where you want to make sure that you've got a strategy that's going to be able to participate in the days that the market's up, but also you build a nice, beautiful safety net down below that. So if things don't go well, you have something to fall back on. You know that there's some sort of safe money location, and it goes down to balance. So I just give this example. So consider this. So I did some math and I just said, okay, so how would this have worked out in practice? So if you were to invest $100,000 in let's just say the S&P 500 before the pandemic, and just wrote it out, realizing all the ups and all the downs, today you'd have probably around $155,000. Now, what if you only received 75% of the ups and 75% of the downs? So you're not getting all the ups, you're not getting all the downs, you're trying to win more by losing less, let's say. Today you'd have around $152,000. So put it another way, you got almost all of the upside by only taking on 3/4 or 75% of the downside. That's the type of environment, that's the philosophy we have at Stonebridge is, hey, let's just make sure that we can win more by losing less. We don't need to take on all of the risk. We don't have to go free climbing on Wall Street with all of our money in order to achieve good returns. We just have to make sure we have the proper balance in place.
I love that. Win more by losing less. Such wise words. And I know we have a lot more to get to. We only have a few minutes left in today's show. But before we get to that final question that I'm going to be asking that's on the top of everyone's minds, this is another opportunity for you to pick up the phone and call 866-256-7778 to get your complimentary written financial plan. This is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how the team of Stonebridge Wealth Systems can help and serve you. We know you have questions. We know you have concerns. We know there's a lot of uncertainty out there. Wouldn't you like to have the peace of mind that comes from having a solid plan in place? We encourage you to call that number or scan that QR code. And when we come back, I'm going to be asking Tim and Jeremy that important question of how should you be investing your money during this election year? Stay with us.
As Americans, we strive for better. From a better house to a better career to a better life for our children and grandchildren. Better has become the American way. When it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better solutions? A better retirement begins with a financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Welcome back to the Retirement Compass, where today we are addressing the fear and uncertainty that a lot of folks are experiencing given that it is an election year. And before the break, I posed to Tim and Jeremy the question that is on the top of everyone's minds. How should one be investing their money during this important election year?
Well, it's a great question. And so to kind of follow on what Tim was saying before we went to the commercial break, the bottom line is being properly diversified. You got to know your situation. And that includes why am I investing in this? Why does this make sense for me at this time? Know your goals, your risk tolerance, your timeline. Timeline is extremely important. And know your financial situation. If you had a major bill come up, do you have cash to take care of that? Or what do we have in savings? So there's a lot of questions that go into that planning, but if you have a plan, we can take that anxiety out of the whole situation and kind of take the sting, if you want to call it that, out of an election year. So if you're sitting at home and you're wondering, what should I do? Or I'm not sure if my portfolio fits what my goals and my objectives are, give us a call. We can sit down, we can walk through that with you, help you uncover some things that maybe you haven't even thought about before, and then put together a plan that helps you achieve your goals and objectives. And so it's really simple. Just give our office a call and sit down with one of our trained staff and team.
Wonderful. Well, any other parting words you want to leave folks with today as we think about this important subject?
I mean, again, to me, it comes down to taking action. I say this often, there's two types of people in this world. Those that are using more as hope as a strategy, hoping things will work out. I know life gets in the way, schedules take over, and I'll wait until after, harvest, or I'll wait until after I get my knee replacement done. Let's not do that. Be like the second type of person that changes their circumstances by taking action to serve their purposes. It starts with calling that number today.
Wonderful. Tim, Jeremy, thank you so much. And thank you for this wealth of wisdom you've provided. Again, we're inviting you to pick up the phone and call 866-256-7778 to claim your very own complimentary written financial plan. Thanks so much for joining us, and we look forward to being back with you next time here on the Retirement Compass.